let's continue our conversation around numbers. The one that reported yesterday was Swiggy, a decent set of second quarter numbers. The net loss widened as expected because of quick commerce investments, but the internals on food delivery, GOV growth, as well as, where the quick commerce average order value and contribution losses declining is going ahead, have been tracking well. But more importantly, the companies also said that they will have a board meet to consider fundraise worth nearly 10,000 crore rupees via QIP or other routes as well. Rahul Bothra, who's the Chief Financial Officer at Swiggy, joins us now. Thanks a lot, Rahul, for joining in. Congratulations on a decent set of numbers coming in. But beyond the numbers, most importantly, I remember, when we were speaking before the IPO, during the IPO, after the IPO as well, you said that we have enough cash on our books. We do not need to tap the markets once again, at least in the foreseeable future. And less than a year, you have, money to be raised from the markets. 10,000 crores is what you're looking at. And this after having sold stake in Rapido for 2,400 crores. So it's not that you don't have cash on your books. Nearly 7,000 crore right now, but you're asking for more. Why dilute equity for another 10,000 crores in almost a year since your IPO?
Good morning, Mangalam. Very good morning to all your viewers. So, as you recall, when we met at the time of IPO, we were in a very exciting quick commerce segment where we were planning almost all the investments. The food delivery business had, of course, turned the corner and started delivering positive, growth and EBITDA. So today, the food delivery business is at a run rate of roughly 1,000 crores on an annual basis, and we are very well, stocked up in overall capital, right? As you rightly said, close to 7,000 crores with the Rapido sale proceeds that are expected to hit this quarter. Having said that, what we have seen in the quick commerce business is that the growth has accelerated. This was the third consecutive quarter of 100% plus growth that we delivered in that business. We've also seen a lot of investments, coming into the sector, both legacy players as well as new players wanting to enter a very, high growth segment. So we felt that this is the right time to, stock up what we call the growth capital. We've also been a very innovative company, and we do expect a few more new services to continue to come out of our stable, as well as raise a strategic reserve that helps us that we may never have to raise again.
Right.
So Rahul, but give us some more color. Rahul, just give us some more color on this. The 17,000 crores that Mangalam alluded to, which in all probability you'll have once this fundraise goes through. Obviously a large part of it will be organic. You'll keep doing your dark store rollouts. But what else? What else are you thinking when you want to have this war chest of 17,000 crores?
Yeah. So as I mentioned, it's a lot of strategic reserve that we really want to stock up. We also don't know how long the quick commerce business will continue to growing at the pace at which it is. We continue to get surprised with the extent of consumer adoption. If you look at just our numbers, we crossed 7,000 crores just in the quick commerce business in the previous quarter. Very strong user additions, doubling our user base over the last year. So we do want to have sufficient, as I said, strategic reserve. And that creates optionalities for us for continuing to invest in the business.
Right. A couple of things. The last time you joined us, you did say that peak of quick commerce investments was behind you. And now you want to build the strategic reserves to go ahead and look at some more investments out here. So there is a bit of dichotomy here. Second part, on the competitive intensity part, how do you see competitive intensity panning out here? Because Zepto has some money. Blinkit has raised some money. They have around 18,000 crore of cash on their books. You will have 17,000 crores. Reported numbers for Zepto would be almost $1 billion. And we haven't even yet spoken about the big guys, the big baskets, the Reliances, and all the others who are eyeing this space. So how do you expect competitive intensity to pan out in the quick commerce space from here on? And what does that then mean for your path to profitability here?
Yeah. So Mangalam, just the announcement of fundraise does not change our trajectory in terms of the profitable growth that we have alluded to. So we have reiterated our guidance that we will get to contribution margin break-even by the June 2026 quarter. So we have maintained that guidance. Even in the previous quarter, we went down from negative 4.6% to negative 2.6% on CM. It's a pretty sharp move up, backed by some of the key performance indicators like the average order value, which had a whopping 40% increase on a year-on-year basis. So we do believe that the business is on the right trajectory. We have also innovated in launching a lot of new consumer features, especially say Max Saver, which helps consumers to upgrade to larger baskets. We've also added assortment with a close to 40,000 SKU selection available on our platform. So a lot of consumer side metrics have started to show up meaningfully in our growth numbers, and therefore we do believe that the path to profitability is well established in this business. Talking about competition, as you talked about a lot of names. We are seeing some bit of activity, but honestly, I think we are staying true to the problem statement that we are solving for our consumers. We think it's a massive opportunity, and we have all the inputs in place to be able to continue appropriating this more than market leading growth from here on.
All right. Hi, Rahul. Good to speak to you as always. Nigel on this side. Contribution margin break even by when? I just want to clarify which quarter?
June 2026 quarter.
June 2026 quarter. Got it. So the first quarter of FY27. That's out of the way. Since you're moving towards contribution break even, the stock market likes to look at EBITDA. EBITDA break even, EBITDA positive number, and PAT positive number. Very clearly, by which quarter will we see Swiggy becoming profitable, both on EBITDA and profit figures? Please go ahead.
Yeah. So, it's hard to kind of crystal ball, beyond, say, some of the numbers that I talked to you about. We also want to retain the flexibility to continue to invest in marketing to attract new users. As I said, we have we have close to doubled our user base in the quick commerce business over the last year. And we continue to see very healthy traction on a new user addition as well as repeat user performance. So we don't want to kind of box ourselves, as we know that there could be potentially more competition. As of now, it is benign. We don't see very, very high competition in the near term. But going out 3-4 quarters, we really don't know the shape of competition that may emerge.
On the food,
retain the flexibility to keep investing at least in marketing while the CM gets into the positive territory.
So on the food delivery part, now we've spoken enough about quick commerce. There is competition, there is intensity, there is growth. All of that is likely. But the cash cow of your business, which is the food delivery business, it's structurally slowed down. Between 18 to 20% is what now the expectations are. Do you think there is fatigue here? Is there any trigger to structurally take it higher from this 18-20% band versus what it has been doing in the past? And while we're talking about competition in quick commerce, Rapido has come up with the food delivery. Has it made any dent in the market where it's pilot testing right now?
Sure. So now talking about food delivery growth, I think it's been a pretty healthy growth in both user addition as well as gross order value addition for us. Growing 19% now consecutively for many quarters, and we continue to see pretty good traction there. As mentioned in quick commerce, similarly in food delivery, we have innovated with a lot of new offerings, whether it is the 10-minute version called Bolt or more recently the 99 store, which gets access to affordable meals to consumers. So I think the overall growth can go up, but we as platforms will have to create more opportunities for consumers to participate in what we call the low value meal segments, and that's some of our efforts that we have started to put in. So we are cautiously optimistic to continue to growing at the same pace and hopefully grow faster from here.
Rahul, the good thing about being a very active customer of yours is that you have a day-to-day, visibility on the platform fee, on the search charges, or the rain fee and all of that. Now, what's interesting is that while you managed to hike platform fee, over the last couple of months, off late, there are some promotions which are talking about above a certain, threshold. For instance, the other charges, you're doing away with them. So clearly, there are some of these promotional rationalizations that are also underway simultaneously. My question to you is this level of platform fee that you have, reached, is that sustainable in the face of the competitive intensity?
Sure. So, Surbhi, as you rightly said, the platforms, we have been able to innovate to find the right kind of consumer pricing. You'll be happy to know that over the last couple of years, our consumer, fee as a percentage of the basket size has actually not increased. So while there's been an introduction of platform fee, we have also given back value in terms of extending our Swiggy One program, which gives you access to free deliveries, unlimited free deliveries, right? So there is a certain yin yang that we do in our business to be able to give consumers access to the right kind of pricing and affordability so that they continue to increase their frequency on the platform.
But my question, which is great, Rahul, I love it as a customer, but my question really is that in the face of unrelenting competition, and that's not going anywhere, right? And we haven't even sort of touched upon what happens when the bigger guns get into the space with their full might. Again, I repeat that question, that the platform fee and the other charges that and you just answered that, right? That it hasn't gone up as a percentage of the total value, it hasn't gone up. Will there be downside pressure in the coming months as the war rages on for the customer's wallet share?
Yeah, no, so we will keep finding avenues to give back, value. I think, ultimately it's the overall cart value that, we have to bring, to bear. There is also participation from the restaurant industry in being able to give, value back to consumers. And we are having a very healthy, conversation along with the restaurant industry that how do we continue to increase the size of our business. So I think there could be, things that could go up marginally here or there, but overall, the focus will be to give a lot more affordable solutions to consumers to help us continue to grow
You
faster.
speak about affordability and your conversations with restaurants. As customers, we know what the listed price on the restaurant menu is versus what's there on the Swiggy or the other apps like that, which includes your take rate, is bumped up by a fair amount as well. But be that as it may, contribution margins, food business 2.8%. You are expecting it to go all the way up to 5% in the medium term. Just wanted to know what the timeline is out here. Do you have a target for this? By when do you get to 5%, the glide path? And you evaded my question on competition from Rapido in the markets that they are currently doing food delivery, and they're doing it by reducing the take rate. So on the back of that, do you think this take rate itself comes down for the industry?
Yeah. No, so specifically on the question of Rapido, I think they are test launched in one city. This is a different proposition to say what currently the food delivery business operates. We have launched a similar offering called Toing in a couple of markets, and as I said, these are pre-PMF bets. Whether it's Rapido or whether us, we will continue to experiment around how do we provide a lot more affordable solutions to consumers. To be able to tap into a higher growth market, but that's a different business segment altogether, a different consumer proposition altogether.
All right, Rahul, it's a good show by Instamart on average order value. But the MTU, or the monthly transacting users, well, that's been relatively slow for the last 2 quarters in Instamart. So when do you see this kind of shift from AOV to MTU? Because that's where the bigger growth will come from.
No, I think for us, the focus remains steadfast on continuing to grow it healthily. I think, both these parameters are important. As I mentioned, we have actually doubled our overall user base over the last year. And, it continues to meaningfully go up. At the same time, with the focus on the profitability as well as continuing to give right value to consumers, some of the initiatives like Max Saver, etc., have also consolidated carts, right? So consumers have been able to, consolidate carts and get a certain, meaningful value out of it. So the focus steadfast remains on being able to attract new users to the category, also convert dormant users, as well as continuing to grow at the back of some of the non-grocery selection increase that we have done, which has meaningfully tripled over the last year, right? So from 8% close to 26%, which is a non-grocery selection, which typically comes with high average order values.
And when does food business do 5% contribution margins by?
EBITDA, I think, Mangalam, you mean, because
EBITDA,
we are
yeah,
close to
sorry.
3% EBITDA. So see, as a business, there's a lot of operating leverage. We are a technology platform. Even in the previous financial year, you saw close to 80 basis points, being added. Even in the current quarter, we saw 60 basis points, adding just on the operating leverage, despite contribution margin, being in a certain range bound manner. We do expect, a certain contribution margin accretion of roughly 100 basis points, and the rest is going to come through operating leverage. And it's a matter of a few quarters from here for us to be able to get to the steady state.
Okay. Rahul, we come back to the capital question where we started. Now, with this war chest of 17,000 crores, once you do this QIP, you're good for how many quarters? Because one thing that public market shareholders usually question is repeated dilution of equity. So you're covered for how long now?
Yeah, no, as I mentioned, a lot of this is strategic reserve. We currently have sufficient capital even on the balance sheet, almost all the IPO proceeds that we raised plus more. And with the Rapido divestment, close to 7,000 crores of cash. So, it's not, this cash is not what I call deployment cash, and not a lot of this is deployment cash for which we have, full usage today. A lot of this is going to be strategic reserve, which we are going to create optionalities for ourselves going forward.
So no equity dilution, say, for what, at least the next year and a half? Can you give us any visibility on it?
I mean, you never say never, but at least here I feel that it could never, happen, because I think, technology platforms, when the transition happens to profitability, we have seen in the food delivery business from negative, 2,000 crores to 1,000 crore positive. It can happen in, a handful of years. And similarly, in the quick commerce business, we have seen even competition being able to demonstrate that pathway. So we necessarily don't see, us to be able to hit the market again. So this is probably one last opportunity for institutional investors if we if we do the QIP to enter the stock.
I'm sure they'll give you the elbow room. You are a new age business, and you are in a business that's getting disrupted on a daily basis. So I'm sure.
The only change that I noticed from then to now is that that time he had said I wouldn't need it for the foreseeable future, and from then he said I don't need it for the foreseeable future, but never say never.
Say never.
Interesting one, Rahul. Thank you so much for joining in and giving us all those details. We obviously look forward to when you raise the funds and what you do with them, and whether you come back again for those funds or not. On a quarter-on-quarter basis, we'll be tracking the performance of your quick commerce business and the margin accretion for your food delivery business as you do along with competition as well. Thank you so much for joining in. Wish you good luck and a good, festive season as we move towards the third quarter.